To our session. So I'm happy to have you all here. So we will start the session soon, but meanwhile, if you have any questions for the panel, make sure to drop them in the Q&A box, not in the chat, so that we don't miss any of them. So we'll make sure to take in as much as questions we can towards the end. And we are also live streaming on YouTube, Facebook, LinkedIn. So feel free to share the session or comment and support us if you're watching from there. So I'm happy to be joined by three experts who live ESG this very day. And yeah, hi, good morning, Samir. Nice to meet you, Samir from Lebanon. And yeah, please keep posting messages in the chat box to make it as interactive as possible. So our experts today are Sami, the COO from Climate Balanced, Kusai, the ESG specialist from our banking sector, and Dr. Ganesh, who is the VP Technical ESG and Sustainability from Nirantra. So good afternoon, everyone. Nice to have you here.
Good
So
afternoon.
good morning, Sala. So yeah, as people keep joining, let's just give a quick introduction about our session today. So the COVID pandemic showed us how vulnerable businesses can get to global shocks and highlighted something very critical, that is environmental, social, and governance, ESG, and how these issues are now central to something long term for a business resilience. Simply put, ESG is about how companies operate responsibly across environmental, social, and governance areas while creating long term value. So it's a wide misconception that these are just about green projects. It's not. It also covers workforce development, governance, risk management, and social impact. So at even the recent COP30, the outcomes were pretty mixed, but one message was pretty clear. Companies need to take ESG more seriously and move from intention to action. And the discussions, they focus heavily on fair transition, stronger social and governance responsibly, and also it's clear that the global expectations on climate finance commitments are rising. So for GCC businesses, this really means that we need to tighten the link between ESG strategy and day-to-day operations, not just to say competitive or attract capital, but to also show that we're really transparent and accountable in a world that's watching more closely than ever. So, hi everyone, welcome. Good afternoon. I'm Meghna Rajagopal, research analyst at Solarabic, and I'll be moderating today's session. That is Decarbonization in Action, ESG Requirements for GCC Businesses. So our goal today is to make it easier and move more from theory to or compliance to explore how actually finance, strategy, and operations work in the real world. So what works, what doesn't, how organizations can take actionable steps now. So we'll start with our first segment. To set the foundation for today's discussion, we need to first set a picture about how GCC stands on ESG readiness and financing. And there is no better person to kick this off than Kusai. So Kusai, the floor is all yours. Please take us through your ESG snapshot for the region and walk us through your slide.
Perfect. Thank you. Thank you so much. Let me just share my screen. So can you see my screen here?
Yeah, it's loading, but you will see it soon. Thank you.
Yeah, perfect.
Yeah.
Can you see it now? It's clear?
Yeah.
Perfect. Thank you for hosting me today. It's my pleasure being here today with great experts in the field. First of all, I just want to highlight something very important. Today, I am talking from a personal capacity. My views don't present any banks or any institute in this field. So just give me to give the audience a quick snapshot about the ESG requirements in the GCC countries. So it started by Saudi Arabia. So we can see here that SAMA, the Saudi Central Bank rulebook includes ESG section and D for focus on ESG. And the Saudi Stock Exchange called Tadawul issued ESG disclosure guidelines for listed entities. And we can see the Capital Market Authority published the guidelines for issuing a green, social, sustainability, and sustainability-linked debt instrument to help the financial sector in their decisions. We can see here that Oman, the Central Bank of Oman issued promoting sustainable and green financial practices. And we can see the Muscat Stock Exchange issued ESG disclosure guidelines in 2023 for publicly listed joint stock companies. This ESG disclosure guideline includes 30 ESG metrics that companies should report on. And we can see in UAE Central Bank that they issued a section in their rule book called Sustainable Finance. And this chapter include three main sections. The first one is about the principle for effective management of climate-related financial risks. The second one about principles for sustainability-related disclosures. And the final one is climate-related financial risk management regulation. We can see as well the Ministry of Climate Change and Environment issued sustainability financing framework. This is very important to accelerate the rollout of ESG in the country. And we can see Abu Dhabi Securities Exchange issued ESG disclosure guidelines for the listed companies. And finally, we can see the federal decree law that issued in 2024 that mandate all public and private sectors companies to measure, report, and reduce their greenhouse gas emissions. And we will talk a lot about this topic in our webinar today. Qatar, we can see Qatar, the central bank in Qatar issued ESG and sustainability strategy for the financial sectors, ESG supervisory principles for banks, and the sustainable finance framework in 2025. As well, we can see Qatar Stock Exchange issued guidance on ESG reporting and sustainability platform dashboard for listed companies to insert their ESG KPIs on this platform, and it's public for all to see their progress in ESG. We can see in Bahrain, the Central Bank of Bahrain issued the following. We can see ESG reporting guidelines, ESG requirements module, section.
I'm sorry to interrupt. Could you please make the screen full screen? Like we see the gray parts. So if you could, yeah.
I don't know if you can you see the screen now?
I can see your screen now, but it's I can see all the presenter view. Please change the view and we'll see the full screen.
Okay, just let me just. I don't know if this. Let me share it again. Sorry. Is it clear now?
It's still loading, but yeah. Yes, thank you.
Okay, perfect. So we can see, like in Bahrain, the final, they have also section in their rule book includes ESG requirements in the common volume part A. And this is very important section. And Bahrain Borsa, they have as well, they have issued the ESG reporting guidelines. The Central Bank of Kuwait, now the final country, Kuwait, the Central Bank of Kuwait issued a circular to local banks on sustainable finance. And the aim of this circular is to encourage the banks and the financial institutions to implement and promote sustainable finance in the banking sector. And the Borsa, Kuwait Borsa issued ESG reporting guide. It's called Unified Direction of for Sustainable Future. This is like a very English snapshot about the requirements, and each country they have more than these requirements. But here I mentioned the requirements for banks in general. Thank you so much.
Thank you so much, Kusai. So that was a very good, comprehensive overview and a great way to start the conversation. So let me build that on a more practical angle. So many companies joining us today are either preparing for financing or planning to start soon. So from your perspective, I'd like to hear like what actions do you think that companies have to take to enhance their eligibility and access sustainable finance offered by banks? And if possible, could you share a real case study from the GCC where a company like successfully secured sustainability linked financing and what they did right?
Okay, thank you for the great question. To improve the eligibility for sustainable finance, companies in the GCC need to focus, let's say, in more practical ways, in four practical actions that usually the banks looking during the credit assessment. We can see establishing the clear ESG governance. The banks need to see the ESG not just a slide activity, but a part of a management structure. This means that we're looking for ESG policy. The company, they have assigned accountability, like they have a dedicated ESG officer or committee for that. They're showing that the board or executive team is aware about ESG risks. When governance is missing, banks see this as a risk for non-compliance and a reputation exposure. Even simple structure make a big difference here. The second point I can see, the second action, like start measuring carbon emissions and your environmental performance. Companies often think they need perfect carbon accounting before approaching banks, but this is not true at all. Banks just want to see scope 1, scope 2, and some cases scope 3 emissions, simple energy consumption and fuel data. We are looking usually for the environmental certification audits or compliance reports. Even we are not looking for perfect things, perfect reports, but we need to see commitment. We need to see things that allow us to classify the activity within the green transition or sustainability linked financing. The third action that we can talk about, prepare simple and transparent ESG data package. One of the biggest delays in approving sustainable finance is the lack of organized information. A bank-friendly ESG data package, we usually looking for annual emissions, environmental KPIs, safety metrics, labor practices, looking for governance disclosures. If you have your project any environmental impacts, we want to see this. It doesn't have to be a full ESG report, just a solid document. This can alone can cut weeks of due diligence process and help us to make the decision, the final decision. And the final point, we want to see clear and realistic KPIs. The bank rewards usually the companies that can demonstrate measurable progress. For example, we want to see the companies, they have KPI to reduce their electricity use by 10% as example. We want to see increase in renewable energy share or waste or water efficiency targets. These KPIs allow bank to structure sustainability linked loans and where the pricing adjusts based on the performance. We don't like looking for perfection, but we expect the transparency and the achievable targets. And here, one of the great examples that I can mention about sustainability-linked loans, what happened this year in UAE? Aldar Properties company, they secured 500 million USD this year as a type of sustainability-linked loans. And this is successful because once I read their story and how they secure this loan, I can see they have a strong ESG governance. They have clear rules, they have reporting mechanisms, and they have baseline data. They have energy, they reporting their energy use, their emissions, environmental performance, and they have realistic KPIs linked to ESG. So the final, let's say, lesson learned from this important story, we can see companies don't need to be fully green to qualify for sustainability-linked loans. They need to be focus on governance of ESG, data readiness, and credible improvement plan. This is what we are looking for. And thank you so much. Yeah.
Thank you, Kusai, for the detailed explanation. And yeah, we don't it was nice knowing that companies don't have to be fully green. So yeah, but we need other things as well. So yeah, we will be launching a quick poll to get to know our audience today. So we'd like to ask you which country are you joining us from today? So we just want to know like how broad our region is spread today. So you can answer the poll and you can also keep it interactive in the chat. So if you'd like to answer us in the chat, that is also great. So I'm joining in today from UAE and yeah. So thank you. Thank you for answering the poll. So we see that majority of our audience today is from Saudi and then followed by UAE, Bahrain, Oman, Qatar, and Kuwait, and also from Jordan and Palestine. And there is a mix from other countries. So thank you so much all for answering our question. And yeah, so now we'll keep the session going. So now I want to transition from financing to the internal readiness that companies need to have, because accessing sustainable finance isn't about just interest rate or loan structure. It's also dependent on data, capability, and internal systems. So, Dr. Ganesh, building on the financing example that Kusai just shared, I would like to ask you, like, what capability gaps do you see in GCC companies that prevent them from providing the kind of ESG data that banks would expect during due diligence?
Yes, thank you. And thank you, Kusai, for the detailed requirements or the regulations from the each GCC country. So you can observe that the GCC states enforce the ESG disclosures via stock exchanges, right? With the mandatory reporting for the ESG. Uh, but and as they have declared that there are 30 KPIs that are to be covered under ES and G, which are again aligned with the global frameworks only, GRI, SASB, uh, SASB, CDP, or United Nations Global Compacts. Okay, so on that basis, as Kusai correctly mentioned, that UAE has mandated all the organizations or the banking sectors for the reporting their GHG accounting. Okay, so which consists of scope 1 and scope 2 emissions, but scope 3 is again under the voluntary basis, and if they have the data, they can report that. And similarly for the Omans again, they have again their structure around the MSX. So on that basis, these organizations or the banks can report their sustainability practices under those frameworks. And both UAE and Oman, they have set their net zero targets for the 2050. So according to that, or the comparison to these two countries, other countries are yet to set their net zero goals or the net zero targets according for the ESG or sustainability report. So now about the capability gap, as you mentioned, the point here is the relevance of such a reporting of the nature of the client's business. Okay, on the perspective of the banks, yes, at the moment, if you were to look at the sustainability reports, of the GCC banks, they are largely speak about what they do internally, but very little on what they expect externally from their customers also. So it is a mutual way, right? So double materiality, what impacts on the environment, that again reversibility, what impacts, what environmental or the regulations outside the organization impacts the internal structure. So as for the companies, unless it is clear what they are expected to report and in which framework they will be chasing their trails, like for the establishing the internal system, internal structure for the sustainability reporting. So everyone is quite confused whether which format is to be followed or which guideline needs to be followed, whether it is a national guideline, whether it is an overall global guideline, and which is more relevant to their businesses. So that is somehow lacking, and for that gap assessment, companies needs to be, or the banks needs to be work on. So the gap lies in the regulations as well as in the delivery for the publishing their sustainability practices for the customers as well as the external stakeholders or the investors also. So thereafter, the regular gaps in terms of transparent reporting. So about the practices, sustainability practices in terms of environment, in terms of social as well as the finance aspects. Our banks or the organization needs to be transparent about their reporting, including that the data availability and the collection of the challenges of that data. So that is the major gap we see during the applications, right? Then comes next to the data collection, quality of the data, accuracy of the data, which they are gathering from the resources, whether they are gathering the data on the actual basis, or they are assuming, or they are taking as an average from the published data. So that is again a challenge. Apart from that, complexity of the impact assessment. After reporting or after collecting the data, what will be the impact and how that impact should be assessed and will be helpful to improve the practices of the organizations that needs to be there. Addition to that, knowledge base, yes, internal staff, internal practitioners are need to be knowledge about internal practices as well as the external regulations also. What are changing, what are not changing, and what is applicable or the relevant to the that bank or to the company. And final and foremost, talent. The talent needs to be retained or the attracted towards the company by the practices, ESG practices or the sustainability practices within the organization itself. So that gaps are there and that needs to be fulfilled. For the last point here, as an UAE has already established their reporting requirements as per the ADX or the or the Dubai finance market frameworks on that basis. Perhaps banks, UAE banks, this could be a good compliance guideline to work with and to follow those guidelines according to their requirements. Thank you.
Thank you, Dr. Ganesh. Very insightful. So let's take that one step further and move from capability gap to practical execution. So, Sami, you work directly with organizations to embed sustainability into day-to-day operations. So, from your perspective, I'd like to understand, how do these capability gaps impact a company's ability to actually implement ESG internally beyond just reporting?
Hello, everyone. So, I mean, addressing your question, I would like to first start with, explaining that, I often hear it that it's misunderstood that sustainability is only referring to the environmental section. I'm sure that a lot of our audience today knows what these are, but in regards of ESG reporting, it mainly, covers environmental parameters, social parameters, and governmental, let's say governance parameters. So, I mean, it's not that companies should only wait for regulations to come, such as my colleagues have mentioned. In GCC, there's a lot of regulations coming in place, but we're also seeing some private companies doing these initiatives in this region prior to receiving the, let's say, requirement from the government to actually start reporting. And this mainly comes because as companies, which is, let's say, medium and large scale companies, are doing business internationally, we see that momentum in the EU in regards of reporting. US and some Asian countries are coming in picture in a fast manner. So either their buyers or suppliers would like to connect with companies that are actually sustainable in all three parameters. So that's where things start to get interesting, because companies, let's say first reporters, or let's say companies that are still new to reporting, they see these, bunch of questions that they need to, gather this information from their operations. But what actually happens is that these, let's say, majority of this information are actually there in that company, but it's scattered. So it's not unified in one report. It's not unified in one, let's say, place that they can monitor, or let's say start getting this data. So what I'm seeing is that companies start to identify these gaps. And once they start measuring each of the parameters, either their environmental impact or social impact or their governance, they start to increase their performance, because basically these companies will, put the key material topics, which is mainly impacting their company and impacting the environment and society, and then start working on these actual measures. We often see that benchmarking, given these, parameters between companies, between peers in the same industry, is also important. This helps companies actually, when they start to report or they start to measure, to know which gaps they have in their company. That's basically the main thing that comes into the operation. As well as, let's say, the knowledge gap in these, in the first reporters companies, is the thing that we see bottlenecks in, because first the ESG committee or the focus group for that company start to understand what is it, what's ESG, why it's required, which department actually has to work on it. Is it the strategy? Is it the sustainability department? Is it the risk? And they slowly start to mature. Usually, it follows under the risk, or under what we see is actually companies start to have their own sustainability department and do actual hiring, because these things are, constant. Reporting is constant. Actually, measuring these impacts or seeing where these companies are compared to other peers in the local markets, the regional, or actually international as well, is very vital for them. We see it coming into picture actually in operations, because not only does this, let's say, reporting or the strategy support the company itself, but it also supports its employees, it supports its stakeholders, and there's a lot of things that can actually give let's say, the push for this company to actually start reporting prior to waiting for regulatory, let's say, requirement to come into each company. So yeah, I think I addressed this, but yeah, looking forward to as well discuss other topics. So.
Thank you so much, Sami. Very, very insightful. So now that we've heard perspectives from finance, capability building, and operational implementation, I want to tie this round together with the combined question for all of you. So if you were advising a GCC company starting its ESG journey today, like in a line, what is your like single most important capability or skill they should develop first and why? We can start with Sami.
All right. So, I mean, yeah, actually, I will be building on why is, that required reporting and, the strategic use of it. So actually, companies start reporting because of multiple things that they need to consider, or actually it boosts. I see a bottlenecks in some companies that want to report, but they cannot tie the addition that they need or the value creation that this reporting and this process itself, because it's not only about reporting, it's about also building the strategies and following it. Let's say in a specific, measurable, actionable, relevant, and time-bound, let's say targets to actually, try to hit as much parameter as possible. But in this process, they will be increasing the stakeholder confidence because it's the main driver actually, because you do have stakeholders, either it's governmental entities, regulatory bodies, or suppliers and buyers. It's starting to connect between internationally. Majority of companies are following GRI. Majority of regulations are also putting the GRI requirements as their let's say benchmark, and start to either comply fully with GRI or comply somehow with some parameters. But it also increases the internal efficiency for the company, because each department will know that these metrics that are being tracked or covered, these are the actual things that they need to start working slowly on, with a target of, let's say, 5 years or 10 years, so they can become a more sustainable company, not only in regards of environment, but their other impacts as well. It actually also boosts innovation and resilience, because resilient is what's actually the sustainability all about. As you mentioned, when COVID hit, we saw a lot of businesses get impacted because they're not very resilient in regard of this pandemic. But it also we can say that sustainability, doing the sustainability reporting or ESG tracking, it actually minimizes the risk for the company, or it identifies the risks, the potential risks, and how we can deal with these risks prior to happening, from all aspects. It also, builds the brand reputation, so it can be used from that perspective. If let's say medium-sized company wants to have business with international companies, either in EU, in US, etc. I mean, because those companies have it in their qualification that any supplier that they want to work with needs to have some kind of reporting. They need to see that these companies are following this let's say specific parameters that gives the boost for the companies to actually do that. Because we see that when you want to do the KYC, let's say for example with any big company, majority of companies are asking similar questions, which these questions is taking, let's say, time from the company to actually report on. But if you're tracking your ESG parameters in a correct way, then you will be easily, taking this information, plugging it in, and showing it to your potential buyer that you are doing this, which also can have a competitive advantage in regards to non-reporting companies or companies without ESG strategies. But also we cannot, dismiss the performance tracking, because that's actually what it is about. So companies not only can increase their efficiencies, but they're tracking a lot of, let's say, KPIs, which will definitely increase their performance. And the final thing that I would also say that it's a tool that companies can use to actually be transparent, not only to their internal stakeholder but also external. I mean, we've seen it with multiple clients that we supported. For their departments after, or let's say their management level, once they start to read these reports and to see what kind of data, they start even exploring that some kind of all right, they will understand each department, what they're doing, what they're actually measuring, and it actually increases the knowledge for the employees inside that company to know how it's operating and how they can collaborate. And yeah, I think I've covered in regards of this question, but I'll leave the floor to my colleagues as well to maybe contribute. So
Thank you, Sami. Dr. Ganesh?
Yes, thank you. So from my perspective, awareness and training of the people in the organization about the ESG and sustainability practices is the most or the first step the organization can start with. Okay, because change starts with the grassroots steps. And as per our experience with the different clients from the different countries, top management people are aware about the regulations, but not the relevance with their businesses. And also the middle level and shop floor peoples who are handling the resources, actual resources like materials, machines, and other sort of stuff which they are consuming during the processes, are almost totally unaware about the regulations or the frameworks or the benefits of the aligning with the regulatory compliances, as well as the standards which are the globally accepted. So making them understand why the data is essential for the measuring the impact of those their activities from the organizational perspective will make it easy to track that actual data and calculate the impact on the processes as well as the businesses also. So the single sentence, that is, what cannot be measured cannot be managed, right? So, however, the companies are also concerned about the cost and ROIs on such compliance requirements. The training of the people who are internal peoples who are managing such kind of data needs to be forefront in the forefront to give them knowledge why it is required and how that can be beneficial for the environment as well as their on from their perspective as well. To help that at Nirantara, we built an ESG SaaS platform called as Vajra, which we are offering literally free of subscription for life. Why? Because so that the companies can at least start collecting the data and recording it without worrying about the costs. Okay, and I think that will boost the ESG awareness first, and then it will lead to the maturity over time. That's my thought.
Thank you, Dr. Ganesh. That was very insightful. Awareness is key. So, yeah, next we will go with Kusai.
Perfect. Building on what Sami and Dr. Ganesh mentioned about aligning your policies with different requirements like GRI, IFRS, your national central bank, the national stock exchange, and in addition to the building capacity and awareness. If I had to choose one capability for a GCC company to develop first, as per your question, it would be carbon accounting and emission measurements. Because I see like without knowing your emissions, you can't access sustainable finance. You can't set a credible KPIs, and you can't integrate your ESG into your operations. So I see like carbon data as the foundation that link financing, operation improvements, and a long-term strategy. So once the company can measure its footprint, every other ESG action becomes clear and easier and more impactful. Sorry.
Thank you so much, Kusai. Thank you all panelists. So before we jump into round two, we would like to get to know our audience a bit more. So we'd like to give you a poll. So we want to know which sector or industry do you work in? So we want to know like who are you and which industry are you representing today? So you can also post it on the chat if you prefer, and we'll see. I hope it's consultant, but we will see. Okay, today, yes, our majority is consultant. I was right. And then we have academia, followed by EPCs, developers, service providers, O&M, and others. So thank you so much for answering the poll, and we will continue on to our session. And thank you so much, panelists, again for the responses. So we are now moving into a theme that almost every GCC company struggles with, ESG, talent and data. So Dr. Ganesh, I would like to ask you from your experience across the region, what ESG skills are currently hardest to find in GCC companies? So is it carbon accounting, impact measurement, reporting framework, or something else differently?
Sure. Okay. In the first place, all these skills are equally important to embark on the ESG and the sustainability journey. So lack of any one of them or all of them has the same impact because the circle cannot be completed for the ESG reporting. What is even more dangerous than no skill is partial knowledge. Okay, so which can lead to devastating impacts through misreporting or greenwashing of the organization through the reporting and penalties also, which is the final impact. So I will give an example, not from the GCC but the different region where total lack of application has led to a company which I cannot name right now, but not just the misreporting but also facing the regulatory actions with the penalties. So companies and their sustainability managers should be aware about the applicable frameworks, which is most relevant to their practices. Okay, as well as the changes in the frameworks. What are the changes continuously happening in those frameworks that needs to be adopted? Third thing is the underpreparedness from the internal aspects, from the let's say staff, people's sustainability team, or the top management also. If they are not into this fully, it cannot trickle down to the shop floor, right? So that underpreparedness will be the key, or the lack of experience in the risk assessment and the management of the businesses in terms of carbon measurement or the impact assessment of the company. So these are the critical things or the skills that needs to be there. I don't. I'm not saying that all the things are into one person. It should be a team, right? Sustainability team. So all the aspects should be covered. And this disconnect between the external messaging means the external regulatories or the frameworks and the internal practices who are not aware about such kind of practices leads to this kind of regulatory scrutiny or the significant penalties, right? So the from the example, what the lessons were learned was the data quality concerns. Means the 88% of the identified data was not qualified. Okay, and that is because of the decision making lack of decision making of the top management or the credibility of the sustainability manager or the team, sustainability team. I would not say one person's job was there, but the team. Then the manual inefficiency. So siloed data and the manual processes cause delayed for the reporting of sustainability practices, inaccuracies into the data, into the calculations, into the reporting also, and interpretation also, what those data or those calculations mean. Okay, and the compliance risk, which ultimately goes on the higher side. And the third and last point, which is the main, is the fragmented frameworks and the complexity. Means the clear and clarified framework, what the actual relevant framework or the guidelines was for the organization business or the business was not followed, and those gaps in the reporting was a significant aspect for the penalty. Thank you.
Thank you, Dr. Ganesh. So we will connect this with the world of financing again. So Kusai, to you. In your role within banking, so I'd like to understand, how does a client's ESG performance actually influence decisions on green loans, sustainability-linked loans, or preferential financing terms? And could you explain to us what are the common mistakes you might see that companies repeatedly make?
Thank you. Like, if you can see, like, ESG performance today has a direct and measurable impact on how banks in the GCC make financial decisions. So we can see, like, especially for green loans and sustainability linked loans. The first thing that I can see about the eligibility, it's important to mention that each bank has its own criteria and requirements for eligibility. But before anything else, bank assesses whether the company meet ESG requirements by compliance with the environmental laws. As example, we can see, like, usually we check the records if there's no major safety or label violations. We are looking for the governance structure in place, if there's any governance committee govern the ESG practices in the company. So if these minimum standards are not met, the company will either be declined or asked to be implement corrective actions before financing. The other point that I can say about the risk assessment and the pricing. So ESG performance now feeds into our credit risk scoring. So good ESG performance reduce our operational risk. As example, regulatory exposure, reputational risks, long-term transition risks. So this allows banks to offer better pricing, longer loan terms, and reduce collateral requirements. So I can see, like, weak ESG performance often means high risk premiums. The other point that we can mention here, the qualification for the green or sustainable linked loans. For green loans, as example, the company or project must meet the bank green criteria, such as renewable energy, energy efficiency, low carbon technologies. In some countries, this is defined as their national green taxonomy. So to identify what's the green and what's not green. And for the sustainability linked loans, pricing is tied specific to KPIs like emissions reduction, energy efficiency targets, waste reduction, safety performance, and other KPIs. So like, the banks see the good ESG data leads to lower the interest margins when targets are achieved. And common, like, we see the common mistakes companies make that no ESG data at all. So they apply for green loans, but they don't have ESG records. This one of the mistakes. The other mistake is unrealistic KPIs. We receive a lot of companies, they want to reduce 40% of their emissions in 1 year. So this one of the indication that see that they need to be more aware about their KPIs. And we can see this mainly in SMEs. So we see that the SMEs, small and medium enterprises, need more, let's say, capacity building in the field of ESG. And can see, like, one of the mistakes is the policies just on paper. We can see ESG policy, we can social policy, we can human rights policy in the companies, but just in paper and not in the implementation. So we like banks, we are looking for real actions, not just PDFs and PowerPoints. And this is a crucial part of our due diligence studies. And the important point that as well mentioned by my colleague Sami, is about the companies. They have one of the biggest mistake that they just looking for ESG as is only environment. No, it's not only environment. We have social, we have governance risks. You should covered by your company. So this is like a briefly what common mistakes that I see in the during financing in GCC companies. Thank you.
Thank you so much, Kusai. That was very clear. So now I want to move from reporting to value creation. So Sami, I'd like to ask you, companies often treat ESG reporting like a compliance exercise, but the real benefit, like Kusai mentioned, is when ESG data is used to improve operations. So my question to you is, how can companies move beyond compliance reporting to actually using this ESG data to drive operational improvements? And we have a question in our chat, so I will also add it to you. And what emerging ESG frameworks or standards should GCC companies pay close attention to in the near future?
All right. So I mean, the kind of let's say building on what Qusay mentioned is that because companies usually do, let's say, first report. So we see some companies do the first report and second report, but don't actually see the values. And main reason coming because they are not able to utilize this data, or nobody is actually in that company focusing on this data, because we need to see, let's say, the leadership in that company. It could be, a board member or C-suite, or actually department managers getting involved from different, specifically for different departments. They need to be involved. They need to know why these questions are being, asked, why these data is being measured, and how we can do with it. What we can do with it. So that's actually let's say the issues that we see. It could be that the leadership, they should follow, certain steps. First, they need to care about, reporting, not only because of compliance, but also because they need to understand that this is very critical for their companies, because majority of the parameters or KPIs that are being measured will actually support them in their day-to-day operations, etc. They need to be a part, not only care, but they actually need to be either inside the ESG committee or inside the, let's say, ESG focus group. It depends on the maturity of the reporting for that company. They need to actually engage with their team members as well, with their internal stakeholders to know and to see how these information, these parameters can support their departments, like and finally they need to as well lead by saying that, okay, we do have these parameters, we are tracking, what are we going to do, where are we going? So that's basically the things that I can relate to in regards to your question. But I also have to highlight that this reporting is fairly new to this region. Globally, yeah, it has been there, but as any other industry, it's maturing. So we see that, for example, GRI, which is a common framework for reporting, or that's being used by multiple companies, they actually start to have sector-specific reporting, sector-specific parameters for financial, for, let's say, textile industry, for mining. It's different for, every sector has different things that they need to focus on. So we're seeing that these international standards are shifting as well to be not only generic reporting for that company, but also specific. A common practice that we are also seeing, in preparing or in supporting companies in their sustainability strategies, is how can they use this report and other reporting, let's say, requirements. We see some companies having having to track their, let's say, IFC reporting framework, so they can integrate it. We see companies actually integrating the financial data inside their sustainability report and having one annual report that includes financial and the ESG parameters. We see them as well connecting multiple standards, like and including it and mapping it in their sustainability journey. So it's not only reporting. Reporting is the only first step where you can actually measure, but companies can build a lot on their sustainability practices, and there definitely should be some involvement, or actually it's vital that leadership is being involved, either as board members or C-suite for that company. So yeah, I think that's it.
Thank you so much, Sami. So, since we're running out of time, I will just finally, to close our entire discussion, I'd like to take one last forward-looking question for all our panelists. So, I would like to ask you all, like, what is one actionable steps, like, as a takeaway, companies can use to bridge the gap between first collecting ESG data, second securing finance, and third embedding ESG into operations? So could you, like, just due to the lack of time, I would ask you to keep your answers for one line. So we'll start with Dr. Ganesh.
Okay, so the question has the answer only. So to bridge the gap, you have to create the cross-functional committees into the ESG, including the finance and the embedded financing, or the operations and the sustainability department. And one more point is the technology adoption. Okay, so for the collection of the data and having the continuous monitoring of that data, you need to adopt for the AI or the automation or the blockchain technologies on the real time.
Thank you, Dr. Ganesh. Kusai?
Yeah, to fill the gap, I can see, like, from banking perspective, the companies that bridge the ESG gaps most effectively are the ones that build a single and centralized ESG data package. This a very simple and structured document that includes emissions, safety matrices, project KPIs in one place. It speeds up the financing decisions and help internal teams embed ESG in operations, because everyone work from the same source. We have seen, like, this in GCC, where companies that created a unified ESG data pack were able to secure sustainability-linked financing faster than using the same KPI to drive operation improvements. So I can see in one sentence a focus on one centralized system for ESG data management.
Thank you.
Thank
That
you.
was very insightful. Sami?
Yes, I think companies should report and do their strategies, even if let's say the regulations is not mandating them to do so, because early reporter will definitely benefit from actually doing this practice. So yeah, I think that's the single line.
Thank you so much, Sami. So we actually have a couple of questions, and most of them are banking related. So I would like just one question to each, and I've combined the banking related questions to Kusai. So let's start with you, Kusai. How are GCC banks contributing to the Paris Agreement and NDC commitments? And how do you expect regulators and banks to move forward during, like, unified ESG reporting and stricter sustainability linked finance in the next 2 to 3 years?
Um, Okay, I see like there's no single total amount for all GCC banks, but let me say something very important that banks in the region are putting more money into projects that supported the Paris Agreement, and each country they have their own climate plans. As example, we can see UAE, they have banks, they have announced over 1 trillion Emirati dirham in sustainable finance by 2030. And I can see that other GCC banks are also increasing support for the renewable energy efficiency, transition projects. Overall, like I can say, the region is moving. The GCC, I mean, is moving towards climate aligned, green financing and supporting a shift from fossil fuel to clean, let's say, economy. I hope this short answered the question.
Thank you so much. It's very much answered the question. So,
Thank you.
Sami, a question to you from the audience. Do you see meaningful differences in ESG maturity between Saudi, UAE, Oman, and Qatar? And what lessons can be transferred across markets?
Yes, so there is some differences between, let's say, the maturity level, and the main reason is because who started, earlier. I see that, UAE, has started a little bit earlier, but that doesn't mean that, other countries cannot, catch up, because at the end, it's the private business that's, driving this, market, or this, let's say, maturity and sustainability. Of course, the regulatory bodies come in place. We see it, globally in every, country, or a majority of countries that are requesting listed companies in their stock exchange, in their local stock exchange, to actually report these parameters, because it definitely helps the investors to, give a deep, search and to understand the company that they're going to invest in. But yeah, I mean, what can be done is, as you know, majority of the countries are following the same metrics, or the same framework, which is mainly GRI. They're putting some add-ons on, but this is a, huge advantage, because companies in Saudi will be able to compare, let's say, do peer benchmarking or peer analysis for with other companies in Oman and Qatar and Kuwait, etc., and vice versa. So, I mean, the region itself will start, understanding where, this sector is going. These data can be centralized, per each country, and to start actually moving the industry or the sectors in that, optimum situation where these companies are sustainable, and they're sustainable for long years. And yeah, that's, I think, where the things that can be mainly where actually countries and private business can benefit from, let's say, monitoring reports from different countries.
Thank you, Sami. So, Dr. Ganesh, my last question to you, and I think we covered this briefly, and I know what you say. You will say all, but I want you to pick one. So, from a technical standpoint, what are the most urgent ESG skills that GCC companies need to build internally? Is it carbon accounting, LCA, impact measurement, or ESG analytics?
Definitely carbon accounting, because that is the base for the emissions, right? But when you are considering the product assessment, then the life cycle assessment is the gold standard. Okay, so for that life cycle assessment as well as the product carbon footprinting, it is a part of life cycle assessment. So both are the mandatory and the essential to build the strategy around the businesses, how the sustainable products are there, and how the organizations can compete into the market.
Thank you so much, Dr. Ganesh, and thank you all. And this is the end of our session. Thanks you once again to our panelists and everyone who joined us today. So, to just give you a takeaway from our session. What we heard today is clear. ESG in the GCC is no longer about ticking a certain box or reporting for the sake of compliance. It's becoming a capability, a competitive advantage, and in many sectors, also a financing requirement. And whether it's strengthening the ESG data or building internal skills or aligning strategy with long-term value, this shift is also already happening. And we hope our session today gave you practical insights on how you can take back to your organization. And on behalf of our entire team, thank you once again for joining us, and we look forward to seeing you at our next session. Have a great day, everyone.